So we're here on the euro dollar on the 5 minute chart, and I'm gonna go over the two trades that I took yesterday, July 25th on Wednesday. And to start off, right, you can see that there's a liquidity void created at 8 a.m. EST. With the liquidity void, what should you expect? Price to retrace and fill back in the liquidity void. So that's what I was waiting for, right? The liquidity void stopped at 9:10 a.m. EST. Price started to accumulate within this range, and then it started to slowly accumulate upwards. And then with this losing trade that I took early in the day, I thought that this was the manipulation candle, right? This candle created at 11:05 a.m. EST, and then there was a fair value gap that I thought price was going to distribute on, created at 11:10 a.m. EST within this candle's high and this candle's low. I entered, thought price was going to distribute. Obviously, it didn't. This thing just dumped all the way down. But then I realized that this trade that I took, this first losing trade, this was an accumulation, right? Price was accumulating within here, and then price started to manipulate down, and it started to sweep this swing low and this swing low earlier in the trading day, and then price started to manipulate down, right? And then it started to distribute. So I saw there was a fair value gap that was created again, created at 12:15 a.m. EST, and I entered in on that, right? And then price distributed. So there was an accumulation here when I took this trade. That was when price was accumulating within this range. So there's an accumulation, manipulation down, and then distribution. And I entered in on this fair value gap right on this candle at 12:25 p.m. EST. Take profit was set at the high of this candle created at 11:30 a.m. EST. And remember, I trade ICT power of 3. So what he teaches is that there's going to be a liquidity void. And liquidity void always needs to be filled no matter what. No matter what. A liquidity void of this size, look at this big gap that needs to be filled in right here. That needs to be filled in eventually, especially on lower time frames. That needs to be filled in. That's a key level. A key level on lower time frames. And so I set my take profit for this high, knowing that price was going to go up. And look what price eventually did, right? It started to trend upwards. And where did it eventually trade up into? This range right here, right? If I can, yeah, there you go, horizontal line. We'll see that price ultimately traded back in. If anything, this is equilibrium of this candle. Let's mark it out. So from this low to this candle's high, that it traded more than equilibrium. So it traded back into equilibrium, then it started to dump down. So that was a key level that price traded into, and I used that ICT power of 3 entry model, using that liquidity void, using accumulation, manipulation, and distribution with the fair value gaps as well. That's it for these two trades. So this trade, I think I lost around 70 bucks, and then this trade I made 80. So I broke even for the day and some extra dollars in my pocket. All right, see you guys in the next video.